The notion of a barter economy, often associated with primitive societies engaging in direct exchange, is a prevalent myth that fails to accurately portray historical economic systems. This essay aims to debunk the myth by examining historical evidence, highlighting the limitations of barter transactions, exploring the evolution of currency as a medium of exchange, and emphasizing the role of social institutions in trade. To understand the myth of the barter economy, it is essential to define it and consider the common beliefs associated with it. The barter economy refers to a system where goods and services are directly exchanged without the use of currency. One common misconception is that barter economies promote self-sufficiency, implying that individuals or communities can meet all their needs through direct exchange. Another misconception is that barter economies lack a standardized medium of exchange, leading to inefficient transactions. Lastly, the myth suggests that barter economies are simplistic and straightforward, overlooking the complexities of historical economic systems. Archaeological and anthropological research challenges the existence of a pure barter economy. Ancient societies engaged in complex economic systems characterized by reciprocal relationships and redistribution. For example, the Mesopotamians had complex administrative systems and relied on a centralized authority to regulate trade. The Egyptians had a sophisticated system of taxation and redistribution of agricultural products. The Mayans had a hierarchical society where tribute and tribute goods played a significant role in economic interactions. These examples demonstrate that economic systems in ancient civilizations were driven by social and cultural obligations rather than simple direct barter transactions face inherent limitations and challenges. The double coincidence of wants problem arises when both parties must have a desire for each other's goods simultaneously, making barter inefficient and time-consuming. For example, if a farmer wants to exchange wheat for a pair of shoes, they must find a shoemaker who wants wheat at the same time. Establishing value and fairness in exchange becomes subjective and complex, leading to potential disputes and conflicts. Additionally, barter transactions are limited by the divisibility and durability of goods, as some items may be difficult to divide or deteriorate quickly, affecting the feasibility of direct exchange. The evolution of currency played a crucial role in overcoming the limitations of barter transactions. Early forms of money, such as shells, beads, and livestock, emerged as standardized mediums of exchange. These primitive currencies facilitated trade by providing a universally recognized unit of value, eliminating the need for the double coincidence of wants. Currency also enabled more efficient transactions as it allowed for divisible and durable units of exchange. These developments allowed for greater specialization and expanded trade networks, contributing to economic growth and prosperity. Social institutions played a vital role in facilitating trade and establishing trust among individuals and communities. Ancient marketplaces, bazaars, and guilds served as centralized hubs for economic activities, providing a regulated environment for exchange. These institutions developed rules, regulations, and standards that ensured fairness, quality, and reliability in economic transactions. Marketplaces also fostered social interactions, knowledge sharing, and innovation, contributing to the overall development of communities. Trust and reputation became important factors in trade, and social institutions helped build and maintain these essential elements of economic exchange. Understanding the myth of the barter economy has significant implications for modern economies and economic theories. By recognizing the complexity and interdependence of economic systems, we can better appreciate the importance of currency, social institutions, and regulations in facilitating trade and promoting economic growth. This understanding challenges simplistic assumptions about self-sufficiency and highlights the need for comprehensive economic policies. It also emphasizes the role of trust and reputation in modern economic transactions, emphasizing the significance of establishing and maintaining trustworthy institutions. In conclusion, the widely accepted notion of a barter economy is a myth that fails to accurately depict historical economic systems. Through an examination of historical evidence, the limitations of barter transactions, the evolution of currency, and the role of social institutions, it becomes evident that direct exchange was not the predominant economic system. The debunking of this myth encourages us to question and challenge other misconceptions, fostering a more accurate understanding of historical and contemporary economic realities.